Hey, Emmett Dempsey, Treasure Coast Mortgage. Welcome back to the channel. Today's video is going to be about non-QM loans and some 2021 updates post-COVID. Okay, so what is a non-QM loan? A non-QM loan is essentially anything that's not a QM loan. Okay, so what's a QM loan? QM stands for qualified mortgage. And essentially after the 2008 meltdown, qualified mortgages were a way for the CFPB, the Consumer Financial Protection Bureau, our regulators, in order to figure out what are non-risky features. So it's loans with debt-to-income maximums, no risky features like negative amortization or interest only, that are also insurable for legal protection for foreclosures and lawsuits. So it's a way for lenders to compete in the non-QM space without the fear of getting sued, essentially. QM loans are going to be your Fannie Mae, Freddie Macs, your conventionals, your FHAs, your VAs, fit into those very specific boxes of guidelines, and also loan limits, debt-to-income maximums, fixed or slightly variable with no negative amortization. So they fit in a certain box, and as well it can affect condos. It can also affect you as a self-employed qualifying for these QM loans. So a non-QM fills the gaps that a QM loans have, particularly with self-employed borrowers and investors. So what are the different types of non-QM loans? Essentially, there's going to be your self-employed help, as well as your DSR investors, and of course your credit event dealing with those. First one is your self-employed. So your self-employed folks, of course, have, depending on how you write off your income, many times you make the money in the real world, but you write it off in such a way where the IRS, you're writing off your taxes, smartly in order to save money on your taxes. What we do, we have different bank statement loans with non-QM investors. So they'll use 1 year of personals, 1 year of business. There's programs that use 2 years. So basically, they're looking at your bank statements and your cash flow through your business, and that's how they evaluate your income. Also, there's some 1099 only. So if you're a realtor or if you're a high net worth individual, or you write it off and you get 1099s versus W-2s, we have loan programs for you as well, 1099 only program. Okay, so we'll use a factor of the cash flow using the bank statements or the 1099 in order for you to qualify. Next is your DSCR, debt service coverage ratio for investors. Essentially, this is one of the only truly no income documentation loans that are left. It's truly the only stated income in America these days is your DSCR loan. So basically, DSCR stands for debt service coverage ratio. They look at the property's cash flow. So when they do the appraisal, they'll do what's called a 1007. They'll do a rental schedule to figure out how much that property to rent for, and they'll do an expense factor, based on that market rent. And as long as it meets it, then you're good. So long, of course, it's all FICO based and how much you put down. Anywhere from 20% or more, depending on your FICO score. There's some programs that may be a little bit less, but roughly, consider about 20% down. So your DSCR loans are a way for you to expand your investment portfolio without, say you've maxed out your Fannie Mae, Freddie Mac financing. Your DSCR loans are going to allow you to acquire more inventory and without having to document income. Because should you, again, if you're an investment company or you might have a corporation, you can take title in LLC. You can do certain things with non-QMs you just can't do in the QM world. Okay, so those are DSCR loans. Okay, next, of course, is your credit event. Okay, so that's going to be, that was for years the bread and butter of non-QM, whereas 1 day to short sale, 1 day to bankruptcy, those kind of loans. And I've done a lot of those for clients who bought non-QM and then subsequently refinanced after that credit event window expired. But, after COVID and all the craziness that happened in 2020, a lot of those have been curtailed. Now, they're still available, but instead of 1 day, now it's kind of 2 years. So basically your short sales, foreclosures, deed and liens, bankruptcies, things like that. Ideally, they would like 4 years, but 2 years is still better than the 3 years minimum for FHA and sometimes 7 years for Fannie Mae, Freddie Mac. Okay, so your credit events are another major piece. Should you have those short sales, deed and liens, and you want to buy now because it's a hot market, it'll save you a year having to wait. Okay, so your non-QMs have some other good features. They have high loan amounts. There's no loan limits, as well as non-warrantable condos, which here in Florida can be a good factor. Basically, non-QMs have a lot of flexibility. Should you be in a position that you would need a non-QM, you can't qualify for additional financing. Okay, that's non-QM loans in a nutshell. Here's some more videos on my channel you might find useful. If you're looking to buy, sell, or refinance, definitely give me a call. Go to DempseyMortgage.com. Thank you so much for watching, and I'll see you on the next one.